Hi there, welcome back to this channel. I am Juliet, the creator of Concierge CPA, where we learn accounting and finance joyfully. In this video, we are going to delve into the costs listed on an income statement, aiming to gain a thorough understanding of what is presented and how businesses leverage this information to make decisions that enhance efficiency and profitability. In the previous video, we learned about the single-step income statement versus the multi-step income statement. And we were able to see how, by just rearranging the same information, users of the financial statements can gain knowledge and insights into the business performance. If you didn't get a chance to see that video yet, a link is in the description below. Now let's take a quick look at the multi-step income statement to refresh our memory. This format is beneficial for providing a clearer picture of a company's operational efficiency and profitability from core business activities, separate from its other financial activities. It categorizes a company's revenues and expenses into operating and non-operating sections and adds several intermediate subtotal measures of income. Okay, great. Now we know what is operating versus non-operating income and cost. But it's not that helpful for decision making, is it? Not really. Today we're going to take it a lot further and discuss some crucial cost terms and concepts business managers use in their analysis, and you will discover how much information is hidden in plain sight in an income statement. You just need to know how to read it. In summary, we will go over the following concepts: variable versus fixed costs, direct versus indirect costs, the similarities and differences among these four costs, and we will go over the break-even analysis. So let's get started. First, let's get some broad concept definitions out of the way so you can better visualize what we're talking about. Today we're talking about managerial accounting, not financial accounting. So what is the difference? There are two main differences that are important to know. Financial accounting focuses on providing financial information based on accounting standards, and managerial accounting is strictly used for internal purposes. Number two, financial accounting mainly looks back to report on facts and trends, while managerial accounting is primarily forward-looking in order to solve problems or achieve goals. In short, managerial accounting plays a crucial role in business decision-making. It's all about providing managers with the financial information they need to make informed decisions about the future of their business. Unlike financial accounting, which looks at past performance, managerial accounting focuses on the future. Let's dive into our first pair of concepts: variable and fixed costs. First up, variable costs. These costs are expenses that change based on how much a company produces and sells. This means that the variable costs increase as production rises and decrease as production falls. Examples of variable costs include raw materials, direct labor to some extent, and manufacturing supplies. For instance, if you are running a bakery, the more bread you bake, the more flour and yeast you will need. These are your variable costs because they change directly with the volume of bread produced. On the other hand, we have fixed costs. These are expenses that remain the same no matter how much a company produces. They are normally independent of a company's specific business activities and include things like property tax, insurance, lease and rent payments, certain salaries, and interest payments. Continuing with our bakery example, whether it bakes one loaf of bread or 1,000, the rent for the bakery premises remains the same. This is a fixed cost. For managers, understanding variable and fixed costs is crucial for budgeting and forecasting. For instance, if you are planning to ramp up production for the holiday season, you will know that your variable cost will go up, but your fixed cost will stay the same. This is a good graph to depict variable and fixed cost behavior. This graph illustrates how fixed costs stay the same regardless of the production volume, while variable costs increase with production, leading to an overall increase in total cost. This insight allows you to anticipate these changes and manage your resources more efficiently, ensuring your business remains profitable and sustainable. Where are these costs in an income statement? Variable costs are included as part of the cost of goods sold for manufacturing and trading companies, or cost of services for service-oriented businesses. The cost of goods sold or cost of services directly reduces the gross profit. Fixed costs are deducted from gross profit to arrive at operating income. It's important to note that while most fixed costs are operating expenses, some fixed costs can also be categorized under non-operating expenses if they are not directly related to primary business operations. Moving on to the second pair of costs on our list: direct versus indirect costs. Direct costs are costs that can be directly traced to the production of specific goods or services. Direct costs include direct materials, direct labor that go into each unit of production. Like variable costs, direct costs are also included in the cost of goods sold or cost of services, directly affecting the gross profit. Indirect costs cannot be directly traced to the production of specific goods or services. These costs include utilities, rent for factory facilities, management salaries. Indirect costs are generally included in operating expenses. Some indirect costs may be allocated to the cost of goods sold if they can be reasonably applied to the cost of producing specific goods or services, but they typically influence the operating income. Identifying direct and indirect costs is fundamental for the accurate product pricing. By knowing the direct cost, businesses can determine the baseline amount it costs to produce one unit of a product. However, to ensure profitability, companies must also account for indirect costs when setting their prices. This means allocating a portion of the indirect costs to each product. Without this knowledge, a business might set prices too low to cover all its expenses or too high to be competitive in the market. Let's think back to our bakery example. The bakery produces bread and cakes. The flour and eggs directly used in baking are direct costs, but the bakery also has indirect costs, like the rent for the shop space and the salary of the manager who organizes work schedules. The salary of the baker, however, can be traced back to the production of the product, so it will probably be considered a direct cost. To remain profitable, the bakery calculates the total direct costs for each product and then evenly distributes the indirect costs based on the volume of goods produced. This way, each product's price reflects both the direct costs of its ingredients and a portion of the business's overall operating expenses. Let's take a moment here to clear up any obvious confusion. Variable and direct, fixed and indirect sound very similar. So what's the difference? It is true, variable costs and direct costs, as well as fixed costs and indirect costs, might seem similar at first, but they are distinct concepts used differently in managerial accounting and decision making. Variable costs are costs that change in total in direct proportion to changes in the level of activity or volume of production. Examples include raw materials and direct labor. The defining characteristic is their variability with output level, not necessarily their traceability to a specific product. Direct costs, on the other hand, are costs that can be directly traced to a specific product, service, or cost object. Direct costs can include both variable and fixed as long as they can be directly attributed to the production of a specific product. Examples include the cost of materials used in a product and wages for labor directly involved in manufacturing a specific item. Management uses knowledge of variable costs for budgeting, forecasting, and decision making related to production levels. Knowledge of direct cost is used to assess the profitability of specific products or services. It's used to make decisions about discontinuing products, outsourcing, and optimizing the product mix. The difference between fixed costs and indirect costs. Fixed costs are costs that do not change in total despite changes in the level of activity or volume of production. Examples include rent, salaries of administrative staff, and depreciation on equipment. The key characteristic is their constancy, regardless of business activity level. The indirect costs are costs that cannot be directly traced to a specific product, service, or cost object in a cost-effective way. Indirect costs can be both fixed and variable. Examples include utilities, rent for a factory where multiple products are produced, and managerial salaries. The defining feature is their difficulty or impracticality of attributing these costs to individual products. So in summary, while variable and direct costs, as well as fixed and indirect costs, have some overlapping characteristics, their distinctions are critical for management strategic planning and operational decision making. Understanding these differences enables more accurate costing, pricing, budgeting, and financial analysis, leading to more informed and effective business decisions. Now that we understand the various costs categories, let's take a look at one of the most important concepts in managerial accounting, the break-even analysis. This tool is all about finding the sweet spot where a business's total revenues exactly match its total expenses. In other words, it is the point at which your business neither makes a profit nor incurs a loss. Understanding where this point lies is crucial for any business. It tells you the minimum amount of sales needed to avoid losing money, guiding critical decisions about pricing, budgeting, and planning. So how do we calculate this magical point? The formula is surprisingly straightforward. Break-even point in units equals the fixed cost divided by the selling price per unit minus the variable cost per unit. Let's put this into context with a bakery example. Suppose your fixed costs like rent for your bakery space and salaries are $5,000 a month. You sell your signature loaf of bread for $5 and it costs $2 to make each one. Using our formula, we get $5,000 divided by $5 minus the $2. At the break-even point of selling 1,667 loaves, the total revenue exactly equals the total cost, both fixed and variable. Selling fewer than 1,667 loaves would result in a financial loss for the month. Selling more than 1,667 loaves means that businesses start making a profit. This break-even analysis is crucial for understanding the minimum sales volume needed to ensure the business financial stability and is a key tool in financial planning and decision making. A break-even chart can help visualize what we're talking about. Here the number of loaves sold is on the horizontal axis and money in terms of costs and revenues is on the vertical axis. The break-even point is where the revenue from selling your bread meets your total cost. This visual helps illustrate not just when you'll start making a profit, but also how sensitive your profit is to changes in sales volume. Break-even analysis isn't just about avoiding losses. It's a powerful strategy tool. By understanding your break-even point, you can make informed decisions about pricing. Maybe you adjust your prices to lower the break-even point or find your ways to reduce variable costs. Let's analyze this chart. The red line, this line represents the total cost incurred by the business, which includes both fixed and variable. As the number of units sold increases, the total cost line slopes upwards, reflecting the addition of variable costs with each unit produced and sold. The green line is the revenue line, which shows the total revenue generated from selling units at a price of $5 each. This line starts at the origin, 0, and slopes upward, indicating that revenue increases linearly with each additional unit sold. The chart highlights the break-even point, where the total cost line intersects the revenue line. This intersection occurs at approximately 1,667 units, indicating the number of units that need to be sold to cover all costs, fixed and variable. At this point, the total revenue exactly equals the total costs, meaning there is no profit or loss. So again, to interpret this graph, below the break-even point, when the number of units sold is less than the 1,667 units, the total costs exceed the revenue, resulting in a loss for the business. At the break-even point, selling exactly 1,667 units means the business has neither made a profit nor incurred a loss. All costs have been covered by the revenue. Above the break-even point, Any units sold beyond 1,667 represent profit for the business because the revenue from these additional sales exceed the total cost. Managers can use this analysis to set sales targets, adjust pricing strategies, or explore ways to reduce costs to achieve profitability more quickly. It's about making your business not just survive, but thrive. And that is all for today's video. Remember, managerial accounting with its focus on internal analysis and future planning is indispensable for informed decision making. By dissecting an income statement's cost, managers can strategize for efficiency and profitability, ensuring a competitive edge in the business landscape. Hope you enjoyed and learned today. Thank you for watching. See you next time.